Hey everyone, welcome to the Redwood Money September client update. I am not going to have video on today because I do not look adorable like Sophia in that photo. My nose is running, it's fall, and apparently I'm getting sick along with everyone else. But the show must go on. So we're getting into our September client update, and I love these because it's a chance for me to have a conversation with all of my clients at once and kind of package up all the things that I'm thinking about and that are coming up in client conversations. This month, we're going to be really talking about year-end financial planning moves, but a few quick topics before we get into that. The first one is I want to give a shout out to my dad, Chris Clark. This picture on the right is from a pre-retirement fishing trip that we went on last month. And we did it because as of the day that this video is going live, September 30th, it is the last day of my dad working. He's been a chaplain for the last 10 plus years. Before that, he was in semiconductor sales. I'm the youngest of 4 kids, and Dad, I'm so proud of you. I'm so grateful for all that you did, and it's fun to be your financial advisor now as you make this huge transition, this leap into retirement with Mom. So love you, shout out to him, and excited to celebrate you this weekend. Beyond the personal stuff, I'm going to walk through a new feature in your plan, these 5 year-end financial planning moves, and a few investing reminders as we continue to experience volatility. So let's jump right in with that new feature. So in Right Capital, when you access your plan, there's this awesome new feature called Blueprint, and you can access it by logging in and clicking on Profile, and you'll see Blueprint on the right-hand side. And what this does is it just visualizes a few different parts of your plan. So you can see your net worth. If you click on goals, it'll give you a timeline of your goals. And then income, savings, and expenses gives you sort of like a trimmed down money tree. It shows you your income, the ways that you're saving, and your expenses, and it updates along with your plan. So we'll be looking at this in your financial planning meetings, but if you haven't seen it yet, you can access it right now by logging in at Right Capital. Now, let's transition into a few year-end financial planning ideas. I love educating clients. I want you to know what's going on and why we're scheduling certain conversations at different times of year. And some of the things here are going to be hot topics with clients at the end of the year. And the biggest one is I want to make sure that each year you're taking full advantage of the different tax-advantaged accounts that you have. So we want to make sure that you are on track with the retirement account savings and tax advantage account savings that we've done. So I made this table just to show you. For these employer-sponsored plans, 401ks, 403bs, and 457s, you as an employee can contribute $20,500 per year if you're under 50, $27,000 because of these catch-up contributions if you're 50 or older. Now, you can only contribute to these accounts out of payroll, and you need to make contributions by December 31st, 2022. Oftentimes what we'll do is if you have a big windfall, we may really ratchet up these contributions to make sure you take full advantage of them and reduce your paychecks at year end. You might also have funded it smoothly throughout the entire year. You may have, like a client who reached out to me yesterday, already maxed this out, and that's fine. But we just want to make sure that before December 31st, you've made those contributions. And it's good to look at this as we head into Q4 and have 3 months left, because if we need to increase contributions, we can do that. The second account here is traditional and Roth IRAs. Now, lower limits on these, $6,000 if you're under 50, $7,000 if you're over 50. These can actually be funded all the way until you file your taxes. So the latest possible date would be April 15th, 2023. No extensions allowed on these contributions. And you can fund these directly. So you don't need to fund it out of payroll from your paycheck. You can just deposit money from a checking account into the IRA, and you can code it for whichever tax year you would prefer. SEP IRAs are similar. These are for my self-employed employees. You can put a lot more into these. These are like a 401k for self-employed professionals. You can put up to 25% of your income, up to a maximum of $61,000 per year. Again, up until tax day of 2023. And then health savings account, I consider these in this same category because with an HSA, you can invest the balance, you roll it over year to year, it's portable, and it has some advantages. After you turn 65, you can actually take money out penalty-free from this, even for non-healthcare expenses. Limits on those are $3,650 for single coverage, $7,300 for family coverage, and you can make contributions either out of payroll, many of you do, or you can fund directly if you need to top up the contributions to that. So I'm not counting on you as a client to be on top of this. I'm counting on me to be on top of it, but I want you to know the limits because that's going to inform some of the financial planning moves that we make. Second year-end financial planning idea is just a cool thing. There's a lot of interesting stuff that's happening with these rising interest rates. New opportunities for cash, bonds are becoming interesting, and one of the categories of bonds that's becoming interesting is I bonds, and the I stands for inflation, and these are bonds that are tied to inflation. And over the last 10 years, inflation has been really low. It's hovered at or under 2%, which is actually kind of perilously low coming out of the Great Recession. Well, as you all know, it's been all over the headlines. We've felt it personally. Inflation is up. Well, these bonds have an interest rate that is set every 6 months by the federal government. You can put in a limited amount per year, $10,000 per year, but they set the interest rate May 1st and November 1st. And between May and November, and then between November and May, you get that interest rate for the next 6 months. Right now, because inflation is so high, those bonds are paying 9.6%. Now, the downside of the bonds is that if you cash those out within 12 months of buying them, you lose that full year of interest. So really, these are a great strategy for somebody who has a lot of cash on the sidelines. They're not investing it in those retirement accounts, and they probably won't access that cash for 15 to 18 months. So I've reviewed your plans. For many of you, we haven't talked about this because it doesn't make sense at this stage. But if we talk in the next month, it may be about doing these I bonds if it makes sense given your level of wealth and interest and desire to add a little bit of incremental complexity to your plan. Third of the year-end financial planning ideas is just remember, it comes every year. December is coming. And I'm calling out December because as we get into the holidays, those tend to be expensive months. We're traveling, we're buying presents, there's probably going to be higher heating bills this winter. So knowing that it's September and you've got October and November, many of you did a lot of traveling over summer. This would be a great time to maybe pad the emergency fund, to slow down on your spending a little bit if you're able to, in order to have some more buffer in your budget. And I've done videos on budgeting and you can access it in Right Capital, but this is something to be mindful of so that you don't get taken by surprise in December and start the year off flat-footed with credit card debt or anything like that. So just a reminder there, and that you have access to great tools and to me as your advisor to walk through some financial planning around budgeting if you're having trouble getting traction there. All right, fourth financial planning idea is let's review your employee benefits. Typically, this is the time, these next few months, where you're going to go through open enrollment. If it is open enrollment, please reach out to me. You usually have 2 to 3 weeks to choose your benefits, and I'm happy to jump on a call to look at some things. Oftentimes, we'll look at your health plan, make sure that you or your spouse or both of you have the right level of coverage. I really love these HSA eligible high deductible health plans for some people because you get access to this additional tax advantaged account that can save you money on taxes and grow tax free for the future. But there are other planning opportunities in open enrollment like disability insurance, life insurance. I would love to talk with you about those things. Fifth one is plan ahead for charitable giving. I love, and I really think that financial planning, a huge part of this is creating margin for you. Margin emotionally to not be stressed about money, but also margin financially to lift up your head, see the needs of other people, and be able to meet those through the financial surplus that good financial planning can create. And so I want to encourage you to start thinking now and not have a scramble at the end of the year, because if you want to make a tax deductible gift, you need to do that before December 31st of this year if you want to have a 2022 tax deduction. So some of us are talking about gifting shares of stock into donor advised funds in order to batch gifting before year end. You can just do cash gifts as well, but think about charities that you want to support, especially during this time where there's a lot of suffering all over the world and it's making headlines every day. I want to help you avoid that late December scramble, to look at ways that you can be generous at the end of the year. And I want to be able to celebrate that with you. So if you want to talk about this, I would love to talk about it with you. Okay, a couple things related to investing, and then we'll close it up for this month. I want to continue to talk about the bear market that we are back in. We had a bear market low in June of this year, and that just means that the stock market fell over 20%. And it hadn't happened really since 2008 until the March 2020 super short bear market that only lasted like 2 months. And you can see after that happened, the stock market rallied 35% 6 months later, and 2 years later was up 72%. And yet we kind of got spoiled between 2008 and now because the stock market has mostly just gone up and to the right. What I want to remind you of, and I've done this before, but I need the reminder, and I know many of you do as well, is that we expect these declines to happen periodically in the stock market, but we can't reliably predict when they will come. And I know this to be true because I talked with many people between 2008 and 2020, and they wanted to get out of the market in 2011, 12, 13, 14, 15, as the stock market continued to climb and didn't have a decline like this. And had they done that, it would have been a giant mistake. What we can do is recognize that while the past does not predict the future, stock markets are tied to economies, and economies are cyclical. So you can see basically a couple times a decade, these 20% declines have happened. And we're in now already our second one of the 2020s. What you can see from this chart is when you look out at future returns after these 20% declines, after 6 months, 60% of the time we saw positive returns. As you go out to 3 years, 89% of the time we saw positive returns. So I cannot tell you when the stock market will get back to all-time highs that it reached on January 3rd of this year. What I can tell you is that we're down about 24%. The median downturn in a bear market is 24%. The average is 29%. We just don't know if it's going to fall much further or just a little bit. But what we can say is that staying the course has been a great strategy for a long time. Now, I do have some different advice for people who are in the pre-retirement phase versus people who are already retired. If you're a pre-retiree who is a client, we're not really talking about this because I know you plan to put more money into the market probably for decades. So you stand to benefit from these lower prices. As you max out your retirement accounts between now and year end, you are buying at lower prices, which you stand to benefit from because you need your money to grow and beat inflation between now and when you retire so that you can retire well. Now, for people who are retirees, it's a little bit more stressful to see your portfolio take this giant haircut. I would remind you that we're not going to be taking out more than 5% of your portfolio. So 95% plus per year. So 95% plus of your portfolio is going to continue to be invested for years to come. So I don't want you to apply stress to the entire level of your portfolio because we're not going to be selling a huge amount at these prices. Now, withdrawal strategy, and I define that as both the rate that you're taking out, what percentage of your portfolio you're taking out, and which accounts you're taking it out of, whether it's a brokerage account or a Roth IRA or a traditional IRA. These are very important decisions. That's why we're talking about them. And we're going to make sure that we don't put you at too much risk of what's called sequence of returns risk, where we overdraw the portfolio during a bear market. And it means that you're unable to really experience the growth that typically does follow, as this chart shows you, because you drew down on the portfolio too much. Now, final thing I want to remind you about investing is some of you, this is news to you. You don't follow the markets. You have 100 other things that are more important to you to follow. I want to remind you that I, as your advisor, am paying close attention so that you don't have to. So what are we doing as part of your plan? We're continuing to prudently invest in a diversified, low-cost, tax-advantaged way. We are keeping a responsible cash cushion that is your first defense against needing to draw down on your portfolio. We're monitoring your asset allocation because there may be some time here to do a strategic asset allocation to buy stocks low and rebalance some of the bonds out of the portfolio, or vice versa. Automatically, we're rebalancing, whether that's in your 401k or in your Betterment accounts. We're doing rebalancing. You're probably getting emails about that. And I know that for those of you who have Betterment accounts that are taxable brokerage accounts, we're tax loss harvesting. And I know, because you may not know this, but I get CC'd on every single email that you get from Betterment. So if you think you're tired of Betterment emails, I assure you I am as well. So I will get like 10 or 12 of these a day, and you can see this is what the market has done. As the market goes down, tax loss harvesting is a way to harvest losses while staying fully invested. And these emails that came out on September 16th, 19th, 20th, 21st, 22nd, 23rd, 26th, 27th, and even this morning on September 29th are notifications that there is active work being done in your portfolio to increase your after-tax returns even in the midst of this volatility. So I want to provide that reassurance. I'm not calling you or talking to you every week about this because that doesn't help. It just raises stress levels. What we want to do is stay the course and make decisions that represent your time horizon, which for many of you is spanning the next 10, 20, 30 years, not just over the period of 10 months, which is how long we've been in this bear market. So I hope that provides you some reassurance. If you do want to talk about this as we close, I just want to remind you, you can access your financial plan anytime at Betterment or at rightcapital.com. Your investment you can access anytime at Betterment. You can use these QR codes to access those. If you want to chat anytime, schedule time to connect with me at redwoodmoney.com/meet. I've had some great ad hoc conversations with you as well. If you want to text or call me at 408-617-8757, that's my Redwood Money cell. Would love to talk about any planning ideas that you have. And finally, as one final plug for open enrollment, please do let me know when you get those benefits packages, upload them to the file vault, forward that information along to me so I can make sure that you are making efficient financial decisions here. And just think, part of the reason you pay me is so that when you ignore those emails, we at least make sure you're not doing open enrollment at like 11:59 the night before it is due. I'm so happy to help you with that. So thank you all. Hope you had a great month of September, and I look forward to connecting in the months to come as we close out this year.